How Visa and Mastercard actually make billions. Every second, the invisible toll road of global finance. Chapter 1. The Invisible Tap. You tap a card for a $4 coffee. The terminal flashes approved, and the entire ritual is over before the barista turns around. But behind that tiny green checkmark, a message has crossed a hidden financial highway. It has moved from the cafe to a payment processor, through an acquiring bank, across the network, and into the systems of the bank that issued your card. Risk engines have checked the merchant, the card, the location, and the available credit. Then an answer has raced all the way back. All of it happens in a fraction of a second. Visa and Mastercard are often mistaken for banks. They are not banks, and in most transactions, they do not lend you the money. They operate the rules, software, security, and global connections that make the payment possible. Every day, an ocean of purchases flows through those rails. The amount collected from one purchase may look microscopic. Multiply that toll across a planet that never stops shopping, and the result becomes one of the most powerful business models ever built. This is the invisible toll road of global finance. Chapter 2. The Genesis of Plastic. The modern card network began less like a polished technology launch and more like a dangerous experiment. In 1958, Bank of America mailed tens of thousands of unsolicited Bank Americards to households in Fresno, California. The project was chaotic. Fraud surged, delinquencies climbed, merchants were confused, and the bank lost money. But the experiment revealed something enormous. A payment card becomes more useful when many consumers carry it, and more valuable when many merchants accept it. Bank of America eventually licensed the system to other banks. The network expanded, reorganized, and later became Visa. Mastercard grew from a competing association of banks. The plastic card was only the visible object. The deeper invention was a shared set of rules for institutions that did not fully trust one another. At the center of those rules sat Interchange. Imagine a $100 purchase. The merchant may give up roughly $2 in total payment costs, although the real number varies by country, card, merchant, and transaction. Most of that does not go to Visa or Mastercard. The largest portion commonly flows to the issuing bank as interchange, compensating it for rewards, fraud, and credit risk. The acquiring side and processors keep another slice. The card network earns a smaller assessment and processing fee. That distinction is the key. Visa and Mastercard do not need the entire fee. Their power comes from touching an extraordinary number of transactions while taking a thin, scalable cut for operating the network. Chapter 3. The Four-Party System. To understand the machine, follow a single authorization request. Party 1 is the cardholder. Party 2 is the merchant. Party 3 is the acquiring bank, which connects the merchant to the payment system. Party 4 is the issuing bank, which gave the customer the card. Between them sits the network operated by Visa or Mastercard, while gateways and processors translate the merchant's checkout into messages the financial system can understand. When the customer taps, the terminal encrypts transaction data and sends it to the gateway. The acquirer forwards a standardized request into the card network. The network identifies the issuer and routes the request to the correct bank. The issuer checks dozens of signals. Is the card valid? Does the account have enough credit or cash? Does this purchase resemble fraud? The issuer returns an approval or decline code. That response travels back through the same chain, often within a few hundred milliseconds. Yet approval is not the end. Later, the merchant submits completed transactions in a batch. During clearing, the participants calculate what each party owes. During settlement, funds move between the issuing and acquiring sides, net of fees. The card network is the central nervous system, but not the balance sheet. It carries trusted instructions at global scale. This architecture is beautifully asset-light. Banks fund loans, manage deposits, absorb credit losses, and deal with borrowers. Merchants manage inventory and customer service. Visa and Mastercard concentrate on software, standards, cybersecurity, dispute rules, tokenization, and routing. They can process more volume without building a branch for every city or funding every purchase. Their costs rise far more slowly than the value flowing across the network. That operating leverage is why a small network fee can become a vast river of revenue. Chapter 4. The Unbreakable Moat. A fast payment system is valuable. A fast payment system accepted almost everywhere is a fortress. Visa and Mastercard sit inside a two-sided network effect. Every new cardholder makes the network more attractive to merchants. Every new merchant makes the network more useful to cardholders. As both sides grow, banks want to issue cards on the network. Software companies build around its standards, and fraud systems improve from a larger stream of data. The loop reinforces itself. A competitor cannot simply design a better card and win. It must recruit consumers, merchants, banks, processors, and regulators at the same time. It must deliver near-perfect reliability, settle across currencies, survive fraud attacks, resolve disputes, and work with decades of installed hardware. Meanwhile, a merchant can dislike card fees and still feel unable to refuse the cards customers carry. That is the moat. Participation becomes close to mandatory. Cash remains important and local networks dominate certain markets, but commerce is steadily becoming more digital. Visa and Mastercard do not own every payment. They occupy a privileged layer where global acceptance matters most. Their brands also compress trust. A traveler can walk into an unfamiliar store thousands of kilometers from home and reasonably expect the same card to work. The merchant does not need a direct relationship with the traveler's bank. The network supplies a common language and a rulebook. Scale then funds more security, better developer tools, and wider acceptance, which produces even more scale. The flywheel accelerates, and the cost of recreating it becomes almost impossible to calculate. Chapter 5: The Cross-Border Goldmine. The network becomes especially lucrative when a payment crosses a border. Suppose a card issued in Turkey buys a hotel room priced in euros, or an American card pays a merchant in Japan. The transaction now requires international routing, currency conversion, extra compliance, and settlement between institutions operating in different markets. The network can charge cross-border assessments and currency-related fees on top of ordinary processing. Issuers and merchants may add their own charges as well. This is why travelers sometimes see a choice called dynamic currency conversion. The terminal offers to display the price in the cardholder's home currency. It feels convenient, but the exchange rate may contain a substantial markup. That markup is not necessarily network revenue. It can be shared among the merchant and payment providers. The broader point is that international complexity creates more toll booths. A domestic payment follows a familiar local route. A cross-border payment must bridge currencies, regulations, time zones, and banking systems. Visa and Mastercard have spent decades building those bridges. Once the infrastructure exists, each additional international purchase can carry attractive economics. Global travel, e-commerce, software subscriptions, and digital services all enlarge this pool. Money appears to move instantly, but behind the screen, foreign exchange rates fluctuate, institutions manage settlement exposure, and compliance systems inspect the flow. The network monetizes the privilege of making that complexity feel invisible. Chapter 6: The Threat Horizon. No toll road remains unchallenged forever. Governments have spent years pushing back on card economics. In the United States, the Durbin Amendment limited certain debit interchange fees for large banks. Europe imposed caps on many consumer card interchange rates. Regulation can reduce the incentives that fund rewards and reshape how banks price accounts, even when the network's own fee is only one part of the total. Then there are instant account-to-account systems. Brazil's Pix lets people and businesses move money around the clock using public infrastructure. Similar real-time payment rails are spreading across India, Europe, and other markets. They can be cheaper, immediate, and deeply integrated into mobile banking. For domestic transfers, they challenge the idea that every digital payment needs a card network. Central bank digital currencies could push this further, although their designs and political futures remain uncertain. Blockchain networks promise settlement without the traditional chain of intermediaries. But volatility, user experience, regulation, and throughput remain obstacles. SWIFT is different. It is primarily a messaging network for bank-to-bank international payments. Not a checkout competitor, yet its modernization shows that every layer of finance is evolving. Antitrust authorities are also examining whether network rules restrict competition. The threat is not one giant replacement arriving overnight. It is thousands of payment flows gradually finding cheaper routes. Visa and Mastercard respond by buying capabilities, supporting tokenized credentials, connecting to new rails, and presenting themselves as networks of networks. The question is whether they can continue collecting tolls when the map itself is being redrawn. Chapter 7. The Toll Booth of Civilization. The genius of Visa and Mastercard is not the piece of plastic. It is the invisible agreement connecting billions of people, millions of merchants, and thousands of financial institutions. They do not need to own the products, the stores, or most of the debt. They own the language and the pipes through which modern commerce flows. Every tap feels like a private moment between buyer and seller. In reality, it activates a global machine. The toll is tiny, the road is everywhere. And until a new system can match its trust, reach, and reliability, the invisible toll booth remains open. This is macro flow. Follow the channel for the hidden systems moving money, power, and technology around the world.